Okay, good morning and thank you for your patience. My name is Christopher Jurach. I am a buy-side agent here in the San Francisco market and I work for Redfin. Very proudly so. A little bit about my background. I came into this about 4 years ago, almost a little bit more, from the traditional side of agency. And while I've done a number of home buying classes in my career, I'm quite excited to be doing home buying webinars. I think it's an incredible opportunity for both the convenience of you to tune in rather casually, but to get a 30,000 foot level look into what we offer. And what we're going to be covering today is presented on this first screen. If you have questions or wish to raise your hand, there is some information in the chat box, so feel free to check that out. I can see questions as you dialogue with me in the chat box. I'll be able to answer live. Now, there's several ways I can go about it, kind of like many ways to skin a cat. I can answer questions in the chat or vocally, but you're going to be able to hear me. So more or less, I've found it's probably easiest. I'll just go off the cuff and respond to any questions you present in the chat. If you raise your hand, that'll kind of present the same example. Of course, my focus is somewhat involved in being able to explain and stick to the script, so to speak. If you have something more specific about your particular scenario or something you would like to learn about, I'd like to invite you to email me directly. You will have my email when we complete this slideshow and this presentation, because it's going to follow up with you automatically and say, thank you for registering. Here is our slideshow presentation. Feel free to answer any questions, ask any questions directly through that. So that way you'll get my contact information. Further to that, I'd like to also invite you at the end of this, I'm going to remind you and maybe mention a few things about it throughout the presentation, but I do keep a really open home buying class resource shared G Drive folder where I will constantly refresh it and put in 15, 25 relevant current one sheets, infographics, if you will. And these items I like to reference because it'll go beyond and take us a little more depth into how to read a title report. Who are the people involved in any transaction? You may or may not know there's almost 40 different people involved in the transaction, many of them behind the scenes, and many of them would refer to you as their client. So they're working for you on your behalf. You might be paying them, you may not be paying them. They might have already been involved in the transaction from the seller side. But that being said, there are a lot of people involved in kind of learning along the way. Who's involved is part of the process, certainly. Glossary and terms, maybe nomenclature and words and phrases that are used, sort of what we use to describe the market, whether it's hot or cooling, whether it's softening or depressing or prices are stabilizing, things like that. I mean, much of it's going to be rather obvious or intuitive, and some of it might not be. So I've got one sheets on that. How to choose a realtor in your local market, questions to ask at an open house, things like that I want to reference, and I'll be happy to send and share that to you. And then invite you, of course, to what we like to call kind of programmatically as a strategy session, because I think on a personal level, when you develop an agenda for yourself, but leverage something that really works for you. Maybe it's you're able to be patient because you're in a rent-controlled apartment, or you're currently living with your family, so you can be more kind of laid back as you learn about the process and then determine when you find the right home, how to place an offer very strategically. So along that side, I'd like to suggest that a strategy session with a local realtor that you trust is really a great opportunity for you to express very openly your goals, the criteria for their home, and some personal information that may help to define exactly what you're looking for. And then that realtor can, on your behalf, begin to search more avidly, either off-market or coming soon properties, things that essentially will give you a bit of leverage. So once again, I'm going to go ahead and say hello and invite you. You'll see me probably in the top corner of the screen here. My name is Christopher Jurach, and I work in the San Francisco buy-side market. I've been with Redfin for almost 19 months now, sold over 26, 27 homes. I've done both sides of the deal. I've worked on the sell side as well as on the buy side. And what we're going to be covering today is rather obvious. Of course, it's preparing to buy, understanding the local market, and finding your home. Now, you've probably found this webinar event through the Eventbrite page that might have come through the pull down of our website, right? Home buying classes and things that you can learn. So you're kind of already in the ecosystem, and maybe you're avidly using Redfin. I'm not going to preach about necessarily how we're better exclusively in terms of being able to find your home, but I also would like to say that there is some differences that are fundamental. We are not an advertising site. We essentially will coagulate or draw the dispersed information from all multiple listing services, including our own brokerage. So you may see things on Redfin that are simply not available on Realtor.com, Trulia, or any of the other advertising affiliate sites such as Zillow. That being said, we are a brokerage first and foremost, right? And a full service one at that. We can do both sale and buying. And in that process, we're representing the properties that are coming from the multiple listing service, but we're also offering things like a complimentary tour with guidance from an agent. And along that side, information throughout the whole site, right? Data site, the blog, there's all sorts of information that I'm going to speak further about. But that being said, getting your home in closing is kind of the next logical step. And then I'm going to open it up to questions. So once again, Santosh, you asked, is 2019 a good time to buy or wait and keep searching until 2020? That's a great question. A lot of people ask that of me, and I like to say the best time to buy is when you're prepared. And then you'll be able to watch the market more specifically fluctuate and being able to develop a relationship with a local realtor who has a finger on the pulse for not only the market, but also the properties that are in your particular niche, or the style of property you're looking for will be an advantage to you because you'll be trusting them. And I always like to recommend that we build a team. So let's start along. In our preparation here to buy, we're looking at really some of the most fundamental aspects of this, which I'd like to say are most of you being renting in our poll, right? It looks like 96%, so only a couple of you are actually not owners. Most of you are not owners. So that being said, I'd say, renting versus owning does have an actual equilibrium where you might have been at a disadvantage if after 10 years of renting, you've put in $200,000 and not gained the equity. At the same time, if you're currently paying far less than you will in your mortgage, it's an opportunity to share some of those finance preparations into a savings account, right? Build up a reserve, something you can put in a down payment. So determining what that means, rent versus owning, is actually something that can be calculated. And a good example might be looking at NewYorkTimes.com and looking at their rent to own calculator. Length of ownership, certainly a big opportunity for you to understand exactly how long will you be in this home, and is it the right time to buy? Because most people are not necessarily looking for a 30-year home or their home of their lifetime. It might just be an investment property after they leave in 7 years and the family grows. Or it might be an advantage to live right next to where you work in terms of being able to get there to and from for the next 5 to 10 years of your career. It might be a second home near your child who's going to school. And those are sort of length of ownership, contemplations, and certainly very important for determining what your criteria are going to be out of the home, not only the cost, but also the size and how it's going to appreciate in the market. Lifestyle priorities. I think I touched on that a little bit, but do you like to go to the park? Is it important that there is no new construction right out front of your door? So personal finances fold into that. And I think it's really important that you're going to be able to kind of analyze from a topical level very quickly how much you're going to be able to spend. And this is where, as I said before, we're going to try to build you a team. How will that impact your taxes? How will it be important if you have to sell in order to buy? What will it mean once you own to be able to write things off? So, that said, I'd like to say that, again, this slideshow is going to be available after I'm done, and it's going to come to you via email. But if there are any questions that you have, feel free to put them into the chat box. And if you have questions about your particular scenario, we're going to be able to drill down to that a little bit later. I'm going to stay on the script a little bit, partially to be able to get through this. I should have mentioned this earlier, but my goal is really to end in about 45 to 50 minutes, not to rush it, but just to kind of get us through the overview level. So, typically when we present these slideshows, one of the things we're doing on a general level is applying to many different markets. The San Francisco market and the 7x7, of course, has different districts. The west side of the Sunset area is over by the ocean, and the east side is primarily near the South of Market area with a lot of new construction. So a really dynamic housing stock. And when we look here at the housing payment should not exceed 35% of your income, that would be a good generalization, and certainly important if you're trying to be able to achieve other things like pay for college, buy a new car, aspects of your lifestyle, maybe including extra savings or saving for a second home, things like that. So 25% could be recommended, but many of us in the Bay Area are certainly spending probably 40 to 50% of our gross income towards our housing. Now that might also mean things like remodeling and improvements and things that will help for the equity to appreciate. But I want to mention that this slideshow will be kind of superficial in many ways and may not exactly apply. I'm going to dive in a little bit and then back out with some of the more specifics of San Francisco so that everybody can get some information that's important. For example, the Napa market, Sonoma and Marin, while some of you may not be in there, they're going to be dramatically different than some of the 100 sub-districts of San Francisco, which are certainly different from each other, but they all follow some of the same fundamentals. And having your income and your monthly spending and that information rather clear is extremely important, of course, and you may already know this, but I'm going to speak to it rather directly. That information in terms of a tool can be used at redfin.com/how much house can I afford, right? Now there's many different kinds of calculators, and I'd like to invite you right here that working with a local lender, somebody that you trust as a financial advisor, may not actually be the same as a CPA or 1031 tax exchange, but ultimately it's an advisor on the financing side. I'm going to help you in the terms of advising on real estate purchases and be able to help you maybe make good choices, get you into contract, protect your interests while you're in contract. But ultimately, I am not a financial advisor nor a tax advisor. And so when I say building a team, I'm also opening up the Redfin website as a resource for you to be able to discover on your own rough idea of how much it will cost if you were to purchase a home of a certain amount based on other factors. That being said, if you learned what the monthly nut will be, of course, that's going to be applicable in the general sense, but it may be somewhat specific to each house. And I'd say that in more particularly if there is an HOA or if there are other special taxes that apply to this particular home, you might be paying them upfront. They might be hard costs and they might be ongoing costs. So having our free online calculator is certainly very helpful, but certainly only a start to figuring it out. And when I mentioned before about having a local lender, somebody you can trust, accessibility to that lender on a Saturday afternoon after you've fallen in love with the home is crucial to being able to present a perfect offer package in this way. I'll say just last weekend, I had a client of mine that I've been working with for several months. They have a local lender that they love to work with, happen to be right in the heart of Noe Valley. And when I emailed that lender, she was gotten back to me probably within 4 hours. And she was able to generate an updated pre-approval to present on an offer later that evening. So it was crucial because by presenting an offer that's bona fide and at the right price point and shares with the sellers by way of the listing agent that the buyers can afford this property, it's within their threshold of financing, and it's very well matching the offer contract in terms. So it means, we're going to be closing in 25 days. The 30-year fixed loan could be either contingent upon the terms of the loan coming from the lender, or it could also just be a contingent free offer, one we'd say is clean. And so having a responsive lender, being able to make a phone call to the listing agent, answer questions if the listing agent reached out, match the terms of the contract based on what the buyers wanted, that's extremely important and vital that I think that they are really ready. Now, I'm not saying we all work 24/7, but it certainly could be challenging if a local lender is well respected and the buyers who work with them are getting their offers accepted and you are not, because the local lender or the lender in general is just simply unavailable. How do you find them? We have lender reviews in a section of our site called Open Book, and those lenders who have worked to close deals for our buyers or sellers are rated or reviewed. And you can see that in Open Book, the section of our website that covers what we'd call vendors or third-party people working in along and in concert with our contracts. So you'll be able to see those reviews there. Of course, Yelp and other ways to see them, may or may not be biased or limited, but we have a very open, transparent process of being able to offer each of our successful buyers an opportunity to review those third-party vendors that they've worked with. And so that's an important aspect to learning, who you might want to work with. I think another aspect of this is in the complicated San Francisco market, I often encourage buyers to go ahead and get double apped. And that might mean that if they were looking for a tenancy in common property, something one of 5 lenders in the Bay Area offer, fractional financing, that may not be an applicable type of a loan that you would work on all properties. So if you're looking for a condo that's a TIC, you might be working with one lender. And if you were looking for a single family home at the same price point or threshold, you might be looking for a 30-year fixed. And many of the retail banks, local banks, aside, may offer something much more comprehensive or just simply much more competitive. And therefore, a big bank such as B of A or Wells Fargo can offer you a relationship discount unprecedented compared to something that a local lender offering fractional financing can have. And by filling out an application for both types of lending or loans will be an advantage to you, because essentially you'll be able to purchase either property that fits the mold, and we won't have to slow down the buying process to get you pre-approved in the middle of an offer presentation. Learning about whether a direct lender or a brokerage is better for you may depend upon your relationship with your realtor. In that way, I'd say in particular, having a reference or somebody that is referred to you by the realtor could be very important for you to learn specifically how this particular property requires a certain type of lender. I'll give you another example. If you were to be making an offer on condos, typically in a high-rise building, because that suits your criteria, and we run into an issue where there is litigation from the homeowners against the property developer, you may be limited to only a certain type of lender because of the complications of this particular property, right? A good example might be the Millennium Tower, or just about 15 to 20 of the 100 different new construction groups that are projects all around our city. So if you have a high rise that has water intrusion issues and there's litigation from the homeowners against the developer and it's not quite resolved, you may need essentially specialized loans. And that being said, not all lenders work on all properties, and therefore you might need a direct lender, somebody who will actually be willing to take the risk and provide you the pre-approval, and of course in the end the loan. So a direct lender would work different than a brokerage, and a broker might actually outsource the loan but package it for you. And the rates may differ, but they might offer more flexibility, such as lending on property with litigation. On the other hand, they might offer things like a 3% down, 5% down, 10% down loan, or a 10-10 loan. These are opportunities where it might just serve your needs better, and working closely with both the lender and the realtor to define exactly your needs in terms of financing will be crucial to help both sort of package your offer as well as understand the financing and place that into the contract. So we really do like to work together. And while it's not imperative that I give you a referral to a specific lender and you work with my particular lender of choice, I might say, it's important because the better I understand it, whoever that is, the more in concert and alignment we can be, both the lender and the contract and the buyer, and an understanding of your finances so that we don't get you into contract trouble. I'm going to give a little pause, let you soak that in. This is kind of a meaty material here. Next, I'd like to point out, of course, there is some mortgage terminology that needs to be understood, and this can be best defined, again, by your financial advisor. But I'd suggest that the basic mortgage terminology, what we're going to cover here is the difference between fixed rate and adjustable rate. The fixed rate is essentially the type of loan that will stay fixed throughout the lifetime of ownership of that loan, right? So until you pay it off, it's going to stay fixed. The benefit there is that many ways you can actually maintain the same type of financing and know what you're getting into. So a 30-year fixed is probably the most common, but there's also 15, 40, or 10, right? So I think you'd get the idea. If you're buying an investment property and you knew that the HOA was 200 and you had fixed costs as the appreciation and or rent goes up in your market, if you were renting out this investment property, you would have known costs, and therefore you'd be able to determine the delta of how much you're going to be able to earn, right? On the other hand, buying a single family home that you're going to be living in for 10 to 15 years, certainly having a fixed rate loan might offer you the lowest rates, as well as the best opportunity to earn over time. The appreciation will benefit you because your tax basis and other aspects of that mortgage will be lower than the value of the home. An adjustable rate mortgage, on the other hand, is something that may adjust every period. So if you had a 5-year, 1-year fixed, that would be essentially a 5-1. Now a 7-1 and a 10-1 also are offered, but typically you would be buying something like this with a fractional loan for tenancy in common, or you'd be buying because if you were only going to be there for about 7 to 10 years, the risk involved offers sometimes a much lower rate percentage. And I think I like to dispel the idea that many people will shop the rates, and for a couple of reasons in particular. The rates are not actually locked until you're in contract. So if you were searching for 6 to 9 months, even though you might have gotten a pre-approval back in January and now it's October and you're looking to buy, if rates have gone up like they did in the past of 2018, 3 to 4 times, we went from 4.25 to 4.75, and that's dramatic. And if you had not actually gotten into contract, now your pre-approval may need to be updated, and in that way, you have not locked in that rate at all. On the other hand, understanding the difference between what type of property would be better for which type of loan, that's a conversation you're going to want to have with your realtor. Further, I think it's much more important to understand that many of us in this industry who intend to last are out here to build relationships, and we're not merely trying to shop on the lowest rates. You might be able to define super low rates through Rocket Mortgage, but at the end of the day, if your offer is not being accepted because the listing agent cannot call the lender to be sure that the terms of the loan are defined well, because there's no one to speak to at Rocket Mortgage, then it may not actually work too well for you. However, I'd also like to point out, you may find that Quicken loans work very well in terms of ease of use or being able to facilitate a quick pre-approval online, but the personalization of being able to answer questions for financial advisement may be lacking. Now, I've seen a really good program where B of A, for example, offers a combination of Charles Schwab and Quicken Loans, being sort of very competitive in terms of rate. But again, I want to kind of reinforce the importance of having a financial advisor may be able to answer questions about how you're going to pay the loan and what will happen after the loan has been seasoned. You've paid it for 3 to 6 months. Will they be the ones servicing the loan? Will they give you a second home equity line of credit? Will that person continue to build a relationship? And if not, you might find that paying, a 1/4 point or 1/8 of a point more to have somebody on your side for the length of the loan or for a period of time, 5, 10 years of relationship, will be far more important than just getting the best rate. So points. Points are fees paid to a lender upfront in exchange for a lower interest rate. Not all loan products offer to be bought down with points. Often you can buy it down. Say, for example, they offered you a 5% 30-year fixed loan, but if you paid, for a $500,000 loan, an extra $5,000 at the closing, you might be able to buy down 1% and get to a 4% loan. Now, you'll want to talk with your financial advisor or loan officer to determine if points make sense. Some of the benefits are that you can actually use that as a write-off for that particular tax year. Other negatives might surround it. It's a higher expense at the closing. So points may or may not be relevant. Relationship discounts do exist. I want to reiterate that again because I think it's quite important. Yoon asked a question about the difference between adjustable rate and refinance. So if you've purchased a home with a 30-year fixed at a 5% APR, and 5 of 10 years have gone by and they are offering a rate that's far lower, like a 4.5% rate, you could essentially refinance based on the value of your home, which might actually see some appreciation and give you a matter of large equity. So you would basically refinance, meaning recast the loan. And therefore they would give you a new 30-year fixed at a a loan rate that's lower. I hope that answers the question there. In some ways it's kind of obvious, but adjustable rate means that it will adjust every 1, 3, 5, 7, 10 years. So an adjustable rate mortgage essentially starts at one rate, and for the period of time given, say 3 years, at the end of that 3 years, it will essentially then adjust to the LIBOR. That's typically how it works. So if you started at a 4%, at the end of 3 years, for that next 1 year, it will add the LIBOR plus the market rate, which might be, say, 2% plus 2.25%. Each of these loan products will define that. And you might end up going from 4% to 6% for that next 1 year. And now, again, it might stay fixed for 3 more years, but then every 1 year it will adjust. So it can seem a little complicated, especially if we're only talking verbally. But I think if you look more into that, adjustable rates essentially adjust every period, whereas a refinance essentially is a complete refinance. And you may go from an adjustable rate to a fixed rate, or you may go from a fixed rate to an adjustable rate. Many people would often kind of be serial refinancing, changing from one adjustable rate to the next adjustable rate every 3 to 5 years. And for a period of time, that certainly worked. But with instability in the White House and in general uncertainty in our markets, we've seen the fluctuations be unhealthy for constant refinances, because refinancing does have a cost, typically somewhere around 1% of the total value of the loan. So if you're going to have to pay $7,000 to $10,000 just to get a lower rate, it may not actually be beneficial for the next 2 or 3 years. So in other words, you may not get the return of that investment of refinancing for a period of time. Took a little drink of water there. Thank you. So I'm going to kind of take a little pause, let everything sink in, and look around for some questions here. Regarding housing payments should not exceed 30% of your income, Ivan, is this applied to a gross or net income? Very good question. I'll reiterate, it is for gross. The banks typically look at your gross. So if you're making $10,000 a month and you have low overhead in terms of unsecured credit debt, no other lines of credit or trade lines, as they say, things like car payments, if you can show that you have maybe 70% available for your housing, you might qualify for a large loan. What they'd like to see there is that 35 to 40% of your total outgoing gross income does not be spent on the housing aspect, so that you'll have a little bit of room, maybe even required reserves, to be able to actually pay for your house in the event that you lose your job, change jobs, want to take on some sort of secondary debt. So I hope that answers the question for you there. Loan to value ratio, this comes into play what I was just saying. If you're going to be putting 25% down towards your housing cost, If this is $1 million property, that would mean $250,000. And if you put $250,000, the LTV ratio would be 75-25. So some people will be able to put a 10% down and then take out a 10% home equity line of credit. That'd be a 10-10-80. And that type of a loan has a different LTV. The LTV is a way that the lender will calculate the risk. So if you're presenting an offer with 3% down, the seller will sometimes see that as a risk that they may not want to take because you don't have a lot of skin in the game. Now, technically that would be perhaps somewhat dismissive, or in the very, very superficial way of looking at it, maybe rude, but it could also be seen as, just legitimate. If I see somebody who's got 40% down in cash, it's very likely that this smaller loan will complete the close. And if I see that there are contingencies on this offer and you barely qualify for the mortgage and you're spending at the very top of your available threshold of buying power, the loan to value ratio does come into play, both from the lender aspect as well as the seller interpreting your strength in terms of buy. If you want to pay more on the way monthly, is there a way to do that? Does it affect the interest rate or the loan amount? Yoon, that's a great question. I think more specifically, I'm kind of addressing that here because if you wanted to pay more, maybe if I'm interpreting this correctly, put more down to have a lower mortgage payment for the lifetime of the loan, that's a great way to fix your costs. So I often advise buyers to look into this carefully and say, how much do you really want to spend, right? I don't concern myself whether you are spending $500,000 or $2.5 million. For you, what you'd probably be identifying is that if I need to be spending $12,000 a month on my house and I can afford it, I cannot afford $14,000 a month. But if you were, for example, I'll deal with most typical buyers here, you want to spend maybe $3,000 to $4,000 a month on your total mortgage payments. But we do have to consider the taxes, the interest on the loan, and the insurance. So we call that PITI. And the principal, interest, taxes, and insurance associated with your mortgage payment might amount to around $4,000 a month for a $1 million home. And if you cannot afford to spend more than $4,500 a month, you might find that buying $1 million property is your limit. However, you might be eligible to make out a $2 million loan. You just don't want to spend that per month. So the loan to value ratio is how you can factor that in, and you're going to work closely with your lender to determine there how to essentially establish the best threshold of purchase price and payments in what we'd call running a scenario, right? It's that simple. So when you look at a house, and we kind of go back to that how much house can I afford tool, basically what we're looking for is how much do you want to spend and how much will it cost to pay for this house? And so with each offer and each home that we're looking at, if there are costs involved for remodeling or updating or correcting deferred maintenance, we're going to try and factor all that in. Origination fees, I think that's important to touch on because borrowers will pay an origination fee at the closing cost through their lender. Now, every lender is going to call a certain price. I've found that Citibank offers a very low, like somewhere around $1,000. Others, somewhere to $1,200 on up to $2,000 just to originate the loan. Now, this includes fees for the processors, the underwriters. There's also going to be ancillary fees outside of origination, such as appraisal. Title is going to have fees. All of these fees in general are not necessarily just the origination fee, but the origination fee will be coming as a total. And if it's not including other items, it might be baked into the rate. In other words, you might have a higher rate and they offer what they consider to be no origination fees. On the other hand, they might say it's a low rate, but you're going to pay higher fees up front. So kind of like points, watch the origination fee. That'll show up in the settlement statement. And this is something that is mandatory to be disclosed. So that being said, private mortgage insurance does not apply to all loan types, but PMI is often added when there is a down payment lower than the 20%. And it might be a requirement from that lender. Not all lenders have that requirement, and for a broker, they may or may not include PMI. So it kind of depends a little bit on your credit, your income, and your assets. And so PMI may be included, but after a certain point in time, if PMI was included and you've paid down more than 20% of the loan, you might be able to remove the PMI from your PITI, the principal, interest, taxes, and income, along with PMI could add up to more than you're able to afford. Okay, kind of a healthy chunk there, but we're more than halfway through, and I'll point out pre-approvals are what you're after, right? This is going to show the sellers that you are good for the money. And why that's particularly important, pardon me, I'm going to go back there, is that they come in various factors. It's a various styles, right? Pre-qualification are the letters that you're going to get in the mail saying if you have student loan debt, you may be eligible to take out a loan for 50 grand. Now, that's just a pre-qualification. You've shown up on somebody's radar. It might be through a combination of marketing. It might even just be phony. When we get more specific, a pre-qualification letter from a local lender, maybe somebody that you actually have an affiliation with, a relationship, you've got a checking account at a couple different banks, you've got a savings account at another bank. Now, they may say you're pre-qualified, but you'd want to double check that because your assets and income and your credit do fluctuate. And if you had just recently taken out several trade lines or paid them off, depending on when that was in the month, it may not actually show up that day. So you do have to be specific here. And what we'd like to ask is that you get a pre-approval. A traditional pre-approval is the graduated next step where a loan officer is actually running your credit. And that means taking a hard credit pull, and they're going to factor in both your current income, assets, and review of the total holistic picture. And that doesn't mean that they're necessarily helping you financially make the best sound decision, but that does mean that they would look at your buying power, and to give you a pre-approval, they might be able to state at the end of that conversation or sit-down meeting at the bank, you will be eligible to take out a loan for X amount of dollars. Let's use 1 million. If the conditions following apply, such as if you put 20% down, we will promise roughly to give you at least a 4.25% mortgage rate or better, along with A, B, and C, if you have a certain amount of reserves and other things. So once they sort of qualify that, we're going into the element of a pre-approval, meaning you are eligible to take out this loan right now. They can call me, and these are the terms of that loan. Now, when it gets even more competitive, and I highly recommend this, a fully underwritten pre-approval, this would be desktop underwritten or priority buyer. There's various names and terms for this, but essentially what we're saying is that the underwriters at the bank have gone farther with your pre-approval, so much so that it will work good as cash. And that is gold bond right there. That's quite competitive in this market, because if you can think about it, there's a lot of factors that go into being able to promise a very large sum of money. Primarily what they're looking at is the collateral. And so when they do a fully underwritten pre-approval, it's like a credit card for the loan. Now, again, there may be some conditions on there. It does need to qualify through traditional appraisal, right? They are going to send somebody out and make sure that there's not a cracked foundation, all systems are working, that there is no hole in the roof, right? But the underwriting being done up front might promise a significant advantage at the offer table. So when it comes to being competitive, a fully underwritten loan for $1 million versus a traditional pre-approval could simply be non-contingent, not requiring any type of contingency on the financing. You might be confident enough to, based on the price, waive the appraisal contingency. You might also be able to close in as little as 14 to 15 days. Now, many buyers are thinking that in a 30-day close of escrow, I'd be competitive. Now, that's quite true, but imagine if two offers were presented and one could close in 17 days and the other could close in as little as 29 days. Now, the seller is going to be promised a quick close within the time of a month. And for that reason, it's very likely that they're going to want to take the offer that can move the fastest, because it not only prorates a lesser housing payment and lesser taxes, maybe even lesser HOA, but it's also shown that the buyer has done a lot of due diligence in advance to prepare to be able to make very competitive offers. So again, I'm going to strongly encourage every one of my buyers to get fully underwritten, because while that does require a bit of upkeep from the lender standpoint, it essentially promises kind of good as cash at the most competitive level. That being said, when a seller and the listing agent see that type of a pre-approval, they often feel very well assured that the buyer will be able to complete the deal. It doesn't necessarily mean that you would waive contingencies. It just means that you might possibly decide you could if you felt like that was important to you. Will most lenders do a hard check on your credit for pre-qualification? Absolutely. Sorry, let me rephrase it. Absolutely not. A pre-qualification is not any type of background check. It's simply an offer. It may not even be relevant. So hard check on credit only takes place when you're in a traditional pre-approval or a fully underwritten pre-approval. The idea would simply be do that once and then maintain that file with your lender. And I might recommend, if you're going to shop lenders, do that within a 2-week period, because people looking for mortgages are seeing, if I go from B of A to Wells Fargo to First Republic to Citibank, if I did that all within a 2-week period, they will be able to see that my credit has been pulled looking for a mortgage, and they may even be able to use that credit report number. And while they might offer various packages, you'll probably find roughly the same information. It may only vary based on income and assets or the type of loan you're looking for. So different lenders offer different loan products. Okay. So let's see here. I've got, I think, most of the questions answered. How do loans work with financing a fixer-upper? Do we have to have cash enough for repair and renovating? Hema, I'd say definitely you're going to need the cash up front, and it depends on the lender. But while there are all types of lenders, let's be specific here. If you're financing a fixer-upper, you might be able to get a construction loan. You can also get hard money loans. Now, those primarily come from brokers. People who are working very exclusively with individual parties or groups, real estate investors. But if you're looking for a typical retail bank 30-year fixed mortgage, the fixer-upper will have limitations. It does need to have all systems working. It has to be livable. We might need, for example, heating. It might need to have a kitchen. It definitely cannot have holes in the roof or a fractured or cracked foundation. You can get an underwritten pre-approval with your local lender, and if you told them that verbally, it is something you need to ask for. So I will find often that, you go into the bank, you ask for a pre-approval, they're not sure how aggressive you're going to be in terms of buying, and you may need to ask them, sort of require of them, please go as far as getting this fully underwritten. I want a completely eligible offer that can close in less than 30 days. And I think you'll find that any good realtor is going to ask for the same thing of you as well. It will greatly provide it'll be great. It'll be the best advantage you can have at the offering table, that's for sure. Okay, so I'm going to move on through some of this financing stuff, and we'll kind of take it farther. So getting pre-approved, certainly very important. Things that they're going to look at are universal all around. Most of the time they're looking for credit rating, investments in assets, things like 401k. Residential history can actually be applied if you don't have a lot of credit. You might be able to be surprised by the fact that your recent 2 years of payments towards your rental could be applied as a bit of credit. So if you've made payments on time and consistently, that will work to your advantage to add a bit to your credit file. Your work history is going to be important. And if there were gaps, they're going to need to sort that out before it's fully underwritten. Down payment, of course, they need to see that money liquid. If you're getting gift funds, for example, they need to track that. So do speak with your loan officer about this so that you're not simply taking gift funds 5 months before you plan to buy a home, and now they're wondering, where did you get that money? Who did it come from? Why was it such a large sum? Do you have record of it? Things like that will be important. There could be even a letter coming from that the person providing the gift that would help the underwriters structure your loan and understand essentially where that large sum came from. Total debt, that's obvious. Trade lines, I'm going to refer to them. That might be, Macy's credit card, Nordstrom credit card, USAA, any of the credit lines that you end up getting, Visa, MasterCard, or American Express, right? If you have a ton out there, now that might be a deficit, but you'll want to look at this from a holistic perspective. And doing this in advance will greatly enhance your ability to get a good loan. Some of you might be buying in all cash, and you can see how much simpler this will be if you were doing that. However, I'd also offer that getting a cash out refinance or a delayed financing could be an advantage. Certainly the leverage is a benefit. Common loan products. Here we're going to look just kind of briefly. On the top left, conventional loans include things like conforming loans. Now these guidelines have changed a bit, but those will be homes that are loans lesser than approximately $720,000. Now those guidelines have just been bumped up. It used to be about $680,000. A conforming loan will have one type of pricing. In other words, the APR rate will be different than a jumbo loan. Jumbo loans, because they're a larger amount of money, they typically have greater than a certain amount of money. In other words, we're talking about $729,000 or more. So if you were buying a $1.5 million home, and you're putting 20% down, you'd be taking out a jumbo loan. And so the credit score required for that is often good to excellent. The terms there are rather subjective, so those requirements about the numbers of your credit score will differ with each bank because of the loan products that they offer, as well as because of the other parts of your finances are taken into consideration. Rate options, you can get adjustable rate jumbo loans. There's other things like a fixed rate loan that might only offer certain packages in the conforming space versus the jumbo space. But just about all of the conventional loans require good to excellent credit, but they will also offer many different rate options. And the down payments can be as low as 5 to 20%, but it's very uncommon to find a jumbo loan with 5% down. So those are the basis of most loans. FHA loans are rather specific. These are Federal Housing Administration loans, and you might benefit yourself by being able to take out a loan with only 3% down, but then it may require private mortgage insurance. And the benefit there is that if you had a bankruptcy or a short sale or something demeaning to your credit, then you might get away with getting a larger loan than you'd expected for less down with a poor or fair to good credit score. Rate options can vary, and as I said, down payment can be 3 to 5 or 3.5%. Now, I've found it a benefit to actually stick with a conventional loan and put 5% down and get it fully underwritten. I haven't seen a lot of FHA loans get fully underwritten. VA loans. VA loans are quite special. They are a once-in-a-lifetime opportunity to put no money down. You might be very impressed to learn how much they actually will give you, sometimes up to $700,000-800,000. And the rate options vary, but being able to put no money down is an extreme advantage. And of course, that'll be somewhat dependent upon your current income and assets as well. But that being said, not all lenders offer VA loans. So it is something to look into. If I have any veterans in this audience, of the 32 participants today, I'd like to thank you very much sincerely for your service and strongly invite you to take out a VA loan, at least determine what it would mean to get pre-qualified or pre-approved with that, because it's a great opportunity to get into a house and begin to build wealth that way. And I think just because it might not seem as competitive, maybe through word of mouth, I think it's a great opportunity to buy a home. And in the San Francisco Bay Area, I have helped people, and I do recommend that as an option. So it may take a little longer to close. It may require very specific nuances when it comes to the appraisal. There are aspects of a VA loan that are quite unique, but that being said, I would certainly be eager to help get a veteran into a house because they can be competitive. Okay, so let's see here. I think I've got most of the questions answered, and we're moving right along. This is an example of a slide of what a fully underwritten pre-approval looks like. And while it will say your name and address up top, it'll also give the contact information for that loan officer, which is quite important because then it shows when we marry this together with a cover letter and a well-written contract, it'll define that your fixed rate mortgage, loan to value, 80%, 20% down, 30-year fixed, interest only, meaning that's what the interest will be. But what we're looking at there is an interest rate, 4.375, estimated sales price, 950, right? So the loan amount is 760. That's the 80%. And so that's the type of loan where they essentially clarify very exclusively the property type. Occupancy is going to be for primary residence, not an investment. But if you follow all these guidelines, that is good as cash, and that's ready to go. So that's an example of a pre-approval that is fully underwritten, and that's the statement that I would provide with the contract, and then follow up with a phone call from that loan officer directly to the listing agent to share with him the integrity of your credit file. Understanding the changing market. A lot of talk has been about this, both in the news, and again, I'm going to reiterate that you will get a copy of this whole slideshow in an email, but more specifically, the market is changing constantly, and while we might be at the latter end of a 7 to 10 year cycle, starting say around 2010, 2011, and the elongation of our appreciating market may be rapidly changing and fluctuations do occur. I do think it's important just to point out that a changing market is actually rather constant, but the changes occur rather quickly, and it's an art and a science. It's not exactly fixed. It's important to recognize that I'll say last year at this time is not this year, and it may never be like it was last year. So that's sort of the old market. The current market takes some understanding of the old market. And when we present offers to sellers, I do like to say that just because things appreciated at a rate that was faster last year doesn't mean they're appreciating at the same rate. But these are some of the signs that we have seen and that are to the advantage of the buyers. Higher inventory, there are more options, so buyers have more to select from. And when there is more to select from, they are more choosy, and they might either buy slower or take more time in the buying process. Therefore, things don't sell as fast. It could lead to price reductions. Now, it's not always the case in all aspects of the market. I also like to point out, I think, when people ask me about the market, I like to define, are you buying, are you selling, or are you leasing and renting? Because those are all different points of the market. And if you're a buyer and you're looking to buy, then within that, I'm going to ask, where are you looking to buy? And what is the type of product you're looking to buy? Is it a single family home? Is it located with a view over by the beach? And is it a 3-bedroom, 2-bath with 1-car parking on a large lot? Well, you could imagine that might still be very competitive, right? But a TIC, tenancy in common condominium in the south of market, there's quite a few of them on the market right now. And with more selection, buyers can be more choosy. And they might be able to go in with a contingent offer and request price reductions or considerations along that. If you want me to purchase this, I'm going to ask for some credits in the offer, right? So timing. Buyer has negotiating power when it's been lingering on the market for a longer amount of time. It could propose an opportunity for you. Interest rates fluctuating certainly means that the market is changing. What we saw last year were some unprecedented lows in the beginning of the year and a creeping, rising market interest rate towards the latter end of the year, right around fall. Now, it kind of settled down a little bit. Most of the lenders kind of work off of a retroactive quarter. So you still might find some very competitive rates right now. Getting fully underwritten and sort of locking in a bandwidth of rate would be very useful, because if you decided to buy in the spring, this is an ideal time to begin that process of learning what your buying power is, where you want to buy, the exact type of product, how much it's going to cost you per month, and how much it'll take putting money down, how long it will take to close. So when you solve all those problems, I want it in this district, I want it on this block, more or less north facing, I like to get the backyard with sunlight, that kind of a thing, then you'll be determining for yourself how to choose the right home. So when it does come out, you'll know exactly what you're looking for and be able to make an aggressive offer. So that said, it is important to understand that with rising interest rates, the buying power is diminished. And here's a good example of that. I'm going to point that out, that if you were spending $473 $200,000 at this point, right? Because you wanted to have $2,500. As mortgage rates rise, that buying power will be diminished. If you had a higher rate, you would only be able to purchase at this price, right? And as that rate increases, the same home that you'd be able to purchase actually would go down. So I'll rephrase that again just to clarify. If interest rates are trending up and they reduce your buying power, what you would have been able to buy for a 4% rate will actually be the same house but less cost. So you might actually be priced out of the market as interest rates go up. Are sellers affected by this? Absolutely. That doesn't necessarily mean they're willing to take a loss. They're looking at from a net sheet. If I only owe $500,000 more on my loan and I bought the house for $1 million, I'm only going to make less than $400,000 or $500,000, right? So if I'm only making a certain amount of money, I cannot sell it and take a loss. I have to sell the home for a certain amount of money. From the buyer's perspective, just because it's at the top end of your threshold doesn't mean they will be compelled to accept your offer. So anyway, this is kind of an ongoing dialogue, and I wanted to point that out. I think it's quite important. A buyer and their buying power does get diminished with higher interest rates. Houses are staying on the market longer, and it does mean that there's a chance of a price reduction. And with the chance of a price reduction with a home that might be lingering, I'd invite you to check out the negotiating tactics, the strategy that your local realtor can offer. There could be ways that it might be an advantage for you to be quick on the offer if it's a motivated seller, such as presenting an offer while it's coming soon or off market. The other opportunity might be presenting an offer that's bona fide very early in the marketing process. For example, today might be one of the first days it's on the market. Present that offer by the end of the day. Make sure it's non-contingent, offer their price that's more or less at the comparable sales and what the seller might be expecting, and they might accept your offer right away. Bang, now you're in contract. No other buyers can match that, and you did it early. On the other hand, if we were looking at lingering inventory, a house that might have been overlooked, while it may have been on the market in mid-November and then taken off the market right around Christmas time and brought back onto the market at this point, there might be some reasoning to determine that this house either has something, something to overcome, a reason why it's been lingering. Maybe it's near upcoming construction. Maybe it's near development, or in another way, maybe there is some aspect of the home that needs to be defined in terms of the way it was priced and why it didn't sell. And if there was a reason to show that it had been overpriced, that might be an opportunity for you to understand the comparable sales and present an offer that's competitive. So price reductions are possible, but there's also elements to this that are in strategy. Seasonal shifts, I think, I'd like to point out that there is seasonality is different than a trend. So a trend downward or a softening where housing prices are staying static is different than the seasonality. And the seasonality, we do see fluctuations, but primarily the spring is a time when more buyers are out shopping and more sellers are prone to sell, because if people are looking, it's like the price of flowers on Valentine's Day. So the price goes up with the competition, and we tend to sell in San Francisco, especially about 40 to 50% of the whole year will sell in about 3 to 5 months, primarily March 1st to June 1. The time of year that is more beneficial for buyers in the Bay Area, I think, is typically off season, but mostly I like to reiterate again, it's probably best when you're prepared, not so much seasonality, because we have such strong seasonality. The spring is when most people are competing for homes, but that's the only time that certain homes are brought to market. So if you're looking for something that's rather a rare gem, it might only appear during the spring. So that might be the best time to shop and determine where you want to live. It might be the best time to see the most amount of houses, but it might not be the best time to buy. It, however, might be the only time to buy a certain type of home, and being prepared is why you might be able to take advantage of the opportunity by presenting a great offer package with a fully underwritten loan early in the marketing period because you've done all of your due diligence and homework in advance, knowing exactly where you want to buy, what it's worth, and all of the aspects of what that'll incur. So you don't get into trouble buying something that's a little out of your range. Understanding your market. Now, I've talked about this in a lot of ways, but I am going to reiterate that we do have a place called the redfin.com/blog data center. And on the data center, you'll be able to determine many of these aspects on your own. You can plug in single family homes in Oakland, San Francisco, San Mateo, wherever you're shopping. And if you said to yourself, how much is the average price per square foot right now? Or what is the median sale price right now? And where was it last year at this time? And you'll see the fluctuations of the market. So understanding this detail about how long has it been on the market, when would it be considered lingering, number of homes for sale, how do we determine if this is a saturated market or if there's a lot of inventory, the median sale price versus the average sale price for this area. Other aspects that I've included here are sort of San Francisco sale price. Now we're floating in around 1.6 million for single family homes. And that's the median, right? Halfway between the highest and the lowest. But average sale price still floats seasonally. And we're seeing this dramatically. This is last January at the tip of 2018. That's a low, but it went spiked high right around April, May, and then it lowered in the summer. So while these fluctuations occur, taking advantage of it is important to know what the average or the median or even sort of what the comparables seem to sit at. It's not often that they're going to go lower, but the comparable sales will be defining what the seller's expectations are. Who can help a negotiation process with a seller? A great agent. Yeah. Rima, that's really the bottom line. You want to discuss your negotiation and what we'd consider the selling price strategy that's been set is often determined by the listing agent and the area. So in the west side of San Francisco, it's very common that the single family homes are underpriced approximately 25%. And knowing that going into it would prepare the buyers to have expectations to present an offer somewhere around 20% over asking. Now, that doesn't necessarily mean that it's worth that. That's where you'll determine through comparable sales and research what the negotiation style of that agent might be and what the seller's expectations are. So the number of sold listings also fluctuates, right? Very strongly. We can see here less than 10 to 15 listings per month for 2 to 3 bedroom homes, single family with about 1,000 square feet actually exist in the Sunset District every year, right around January. But then it spikes up with more inventory on the market in the spring, the number of sold listings go up. Along with that, the price per square foot goes up. So you can see here we have lows in the spring or winter, lows in the winter, right? 2015, 2016 saw a dramatic kind of peak that we have not quite exceeded. That being said, you can see here, it does vary per district. And at the very top, you'll see average price per square foot, South Beach and Bernal Heights, right? Let me see if I can get my little marker here. I'll show you what I mean. In an area I otherwise might have perceived as transitional or not having a strong community force. And so depending on the style of teaching or what your comfort level is, it'll be important for you to look at the school district a little bit from that perspective of how you're going to use it. The other aspect is, great schools essentially do attract a higher price value for the home and appreciation. And I know that that's a strong draw. Of course, so do Whole Foods, Starbucks, and other aspects like new construction. So, it's not just one variable. I hope that helps. Hema, we've seen school ratings drop after someone we know bought a home in that area. Is it common? I really can't speak about common in terms of what happens, but definitely these things do fluctuate. And San Francisco is quite unique. And the one that I know, because it's where I live and work, and what I'd suggest there is that, for example, if we look at Marin, it is split into a couple of different areas. If you're up in Novato, a lot of people want to be there for the schools. If you're in the southern part of Marin, other people have suggested that maybe that's the less desirable school district to be in, but they actually work from a proximity standpoint based on where you live, your children can go to a public school. In San Francisco, the public school system is all over the 7x7, so your child could be technically required to go to a school outside of where you live. And I think it's probably important just to define that for yourself, again, kind of going back into more than just the ratings, but how you're going to be using the school and interacting. School ratings will be dropped. I've heard that as well. And I've thought, you know, these things are going to change. There's various ways they could be rated. Some as 5 stars. Some might be, you know, kind of another method, so to speak. So I don't want to go too far into it, but I know it's certainly a hot topic for a lot of people. And I'd encourage mostly touring the schools and getting this sense, you know, the other factors for your home: commute, proximity to parks, aspects of the overall district improving over time will be, I think, you know, an area that's up and coming would be a better investment than just looking at it from proximity to one school. For example, a high school your child wants to go to, but that's my thought. Same-day tours. Certainly one of the main differentiators between Redfin and just about any other brokerage or website that I've ever known. And one of the reasons why I've been excited to be working here is because I, as a buyer's agent, will literally show up within 2 hours if you have booked a same-day tour. We call this Book It Now feature. And when you're looking at that house and you see to the right side a face and a name and or an opportunity for you to book a tour, I'd suggest you plan it. If you know you have some time coming up on the weekend, you'd like some guidance, it requires no pressure, no exclusivity. You can simply request somebody to show up and help you get into that home. Now, mind you, not all homes are available on Lockbox. Not all homes being vacant are available because of owner occupants or tenant occupants, or for whatever reason, preparation to be available to sell. So there's reasons why we can't always show every home. But that being said, I think it's a great opportunity for you to get real person advice, boots on the ground experience of somebody who's been writing offers in the area. And that's how we generate those faces. If somebody's written an offer and successfully represented buyers, we put those local agents in front of you as an opportunity for you to schedule a tour with them at your convenience. And then, you know, that's taken a large amount of the work out of it. Now I can meet you there for an open house or meet you there in a private tour. You might have seen it in an open house. You might be kind of locked and ready to go ahead and purchase, but what you don't have is an agent who can provide real estate advice. And this is where that comes in. By the way, we also offer the Redfin refund, and this is an example of us working as a team, taking this commission that is typically in San Francisco, we're a 5% market, and the listing agent and the seller presents 2.5% to the selling agent, the listing agent, and the buyer's agent or the buyer's broker receives 2.5%. Now, if I represent you on the purchase of a home, that 2.5% is actually shared with the rest of my team and also with you in the form of a Redfin refund. This number typically represents about 0.5 to 1% of the total purchase price, and that's fixed. So if it's $1 million home, the number presented on the screen will be what you actually get, even if we pay more for the home or less for the home. So that being said, I think it's quite important because you can apply this to closing costs, you could donate it, or you can take it in the form of a check at the end of closing. Seeing homes in person, I've talked about that at length. I think it's crucial to be able to work with an agent and your investigation, because once we kind of determine, okay, you want 3 bedrooms, but do you really need 3 bedrooms and why? And once we really understand that, it will be an advantage to have the realtor be able to see homes on your behalf, or to advise you within that house, actually be able to tell you what they see. And so it's kind of like an extra set of eyes, but with a professional standpoint. So they can actually share with you what might the strategy of the seller be? Why would they be painting and covering up dry rot? What it might cost to renovate this home? Or what are the benefits of knowing from an agent the trash pickup schedule, the microclimates, the views possible, the local parks, the schools, all these aspects of getting somebody else who has actual experience writing offers, representing buyers, maybe even living in that local district, working on your behalf and touring that home with you. asking these important questions to find the right agent. Things such as how many clients have you helped this year, or what area do you specialize in? How quickly could you get me into a home? Can you show me a home that are off the market or coming soon? These are all questions that I've mentioned before I have in a one sheet, and I'd be happy to provide it to you. If you want to put your name into the chat, I will send you an email after this event, and I will share with you a link to the G Drive folder with home buying resources. And in there is a bunch of different one sheets and infographics and pieces that I like to share with you guys, because I think it's a great advantage to kind of just open up the information portal and provide you with an opportunity to not only interview agents, but know what they talk about, see how they define the market, how do we package offers, things like that. So asking the right questions is certainly very important. And again, I'm going to reiterate that on Redfin itself, all of the agents working for Redfin and every buyer that they've successfully worked with to get them a home, even when we've written unsuccessful offers, the buyers receive an opportunity to give an NPS survey and review us. And so you can look Christopher Jurach up and see all of my recent reviews for everybody I've represented. And therefore, that will be a transparent way for you to sort of interview the agent online. And you can see that for agents out of your area or within your area. And again, I'm going to reiterate that Open Book is also a way for you to look at redfin.com and see third-party vendors and how they've participated as well. So that would be for lenders, title companies, inspectors, handymen. And so moving right along here, getting your home and closing. Once you've found a home, it's time to make an offer. And this is an opportunity for you to work with that agent and determine what the price strategy was. How did they determine maybe the list price so that they didn't miss out on any buyers? And at the same time, what the sellers might expect. And discussing what it might be for negotiation tactics based on either your contingencies or the elements of your offer that might compel the seller to accept your offer. Once you're in contract, I'll point that back out, that the deal room is a section that you will be invited to watch your deal live in escrow. And that's a sure differentiator of Redfin and our technology forward platform. Common contingencies. These are within the contract, whether we're writing in a California Association contract, which is a 9-pager, or the San Mateo County contract, or the San Francisco contract, which is a 7-pager. The common contingencies in place are there to protect you. Most of these are active, and what they actually show is that if it's required that you're going to finance this with a loan and you wanted to present an offer contingent upon you getting a loan, then you must put in a financing contingency. What you can do there is say that if I don't get a loan for at least a 5%, I will need at least 12 days to go ahead and provide this financing, then I will not buy the house. And that protects your down payment, it protects your interest in that contract. An inspection contingency, one of the strongest contingencies you could possibly have, essentially would say that I need a period of time. Typically, the contract includes 15 to 17 days, but you can write it for less. You could say I need 5 to 7 days to go ahead and walk through with a structural engineer, or I need to actually have my architect friend walk through and determine what it's going to cost us to put in 3-5 skylights, as well as replace the roof. I'm going to get a roofing bid. So if you said these things up front in your inspection contingency and in the offer presentation, it might be crystal clear the interests you have. And as agents, of course, it's our goal to advocate for you. So by doing so, what we'd be trying to do is clarify very specifically that upon the condition of doing 1, 2, or 3 things, sale contingency, if I sell my other home, I'll be able to buy this home. Title contingency, upon review of this with my title and escrow officer, I would be satisfied waiving the title contingency. Appraisal, as long as the home shows as through an independent appraiser, licensed and local, that the value of the home is coming in at the value of my offer, I'd be happy to go ahead and continue through escrow and pay for this home. The closing process itself begins with mutual acceptance, and once you have ratified your offer, both buyer and seller have agreed to work on the contract, it moves into opening up escrow. And the way you open escrow is typically within 24 to 48 hours, maybe sometimes 72 hours. You would essentially deposit your earnest money with the escrow officer or with the title company. Now in California, Northern California, title and escrow are the same. It makes it quite convenient. You as a buyer will be their client, and this is a bilateral contract. So if you and the seller are in disagreement, the escrow officer cannot move forward with escrow. The way you open up escrow is determined in the contract, and typically 3% of the total offer is placed as earnest money deposit. Upon that is when you've opened escrow. You state that in contract right up front, and that's one of the first things you'll be doing right away. So I typically advise my buyers to be prepared for that and try to clarify, when will it be due? How are you going to pay? Where will you be paying it? Again, in San Francisco and typically in Northern California, it is the buyers who actually pay for the escrow and title fees, and it is the buyer who could choose the escrow and title company. Executing contingencies begins right away, and the difference there is going to be important to define business days versus calendar days. If you said you're going to close in 15 days, being able to move through any contingencies in place will be critical, because those are going to work on calendar days. Having an appraisal, if you needed a loan, your appraiser will typically take at least 3 to 5, maybe 7 or 10 days before that loan appraiser can actually submit his appraisal report back to the lender, and in the process, it be approved by the underwriters. So you're going to have to factor those amount of days in. The final loan approval is actually given when the appraisal report is complete and all conditions have been met. Closing costs are specified by the lender in the form of closing disclosure. And the closing disclosure itself is something sent to you to be reviewed 72 hours before you actually close. So this timeline will be quite carefully calculated by both the lender, the representing buyer's agent, as well as based on the days of the month. I really like to look ahead and determine, are there any holidays? When are the Saturdays? What is the day of the month upon which we are trying to get into the home, based for the buyer as well as for the seller to get out of the home? Is that physical? Is it physically possible, right? Like if I'm seeing a house that's completely filled with owner-occupant private personal property, and I know it's just not feasible, they can move in 15 days. It may not be reasonable, and they may need a seller lease back or a rent back, as that's called. So anyway, closing costs are an element that can be typically about 1 to 1.5%, not the 2.5% of the purchase price here, 2 to 5%. I find that this, works well for the general, maybe nationwide brokerage, but what we find is on $1 million loan, to put that literally, I would expect closing costs to be about $12,000 to $15,000. So upfront, both the closing disclosure from the lender and the settlement statement from your title and escrow company will specify each and every debit and credit on both sides, going from the seller as well as the buyer, and all of the costs of the origination fees and all the aspects for title insurance or appraisal, all of the elements that have gone back and forth, that will be specified in your settlement statement. And finally, closing day is a day in which you actually probably don't do much but receive your keys, but it will be important that that's the actual day you take ownership. Your name is in title. Your name is also recorded at the county. You're the official owner, so you're going to need to have insurance. You're going to need to have your utilities turned on, right? So naturally, you're going to want to get keys, but it may not necessarily be the day you move in, and you might not physically do anything. This is the point at which the title company and the escrow officer will take your file, go down to the county recorder, and put your name on the record. So that's the final day of closing, and then we'd say congratulations, usually a flurry of email at this point, and basically saying, now you're the official owner. Thank you for working with us. That being said, what's next? I'd like to invite you again that if you'd like me to give you a link to the G Drive folder with the home buyer resources that I like to share with these attendees, please put your name up into the chat, and I'll follow up directly. If you'd like to speak with me, you don't have to work with me. If I can answer any questions, you're welcome to email me or call me directly. You're going to get an email to follow up with this saying thank you for coming, and at the same time, you're going to get a copy of the slide deck. You can, of course, book tours with us. If I can refer you to a local lender who will work in your market, if I can refer you to a local agent that can help you represent you in buying. If I can answer questions about your particular scenario or you'd like to work with me, I'd love to be able to help you. I certainly do this because I like to immerse myself in the community and discuss this consistently. I'm passionate about it, and I'll look forward to speaking with you now. I'll also open this up if you have any questions. I'll give about 5, 10, 15 minutes to cover a few questions if you have, just to kind of wrap this whole presentation up. We can go back, and thank you for attending. Thank you for using Redfin. I know there's many compelling reasons to use it. As exciting and simple as it is, I also like to be as transparent as I can and say, I think we're a great company. We work with diversity and inclusion, and our focus is really transparently trying to empower the buyer and empower the consumer by providing a bulk of information for free right up front through our website. I'm a paid employee who does not work exclusively on commissions. I don't earn more money when you buy from me or don't buy. I have health insurance with my family, so I'm excited to be, representing Redfin in this accord. And I think you too could be excited about working with us. I think it's an incredible opportunity to work with Redfin, especially through the Book It Now feature, and I'd encourage you to test that out. So thank you again for attending this webinar. Have a wonderful rest of the weekend, and I'll look forward to seeing you out in the market, all right? Alex, I just want to touch on your question. If a selling agent provides inspection paperwork in advance, is it still the buyer's interest to run an independent inspection? I would suggest that actually the best way to start with your review of the inspection report is by calling the inspector directly. They are very proud of their work. They are licensed. Their report is a fixed document required as a part of the disclosure if it's been completed, and once presented is a great opportunity to speak with a professional. If you feel it is in any way lacking, like it's not specialized enough, you are invited to, during the marketing period, bring in your own inspector. During the inspection period, once you're in contract, utilize that time to inspect to your desire to perform due diligence. So I think it's a great start. It's kind of like general contractor report typically looks at like a doctor would. Refer to a specialist if it's something outside of the scope, but they may have great eyes. They may be able to give you ballpark figures, and many times they're going to see things from a professional level that are universal. So if they have findings in that report, it is to your advantage to go ahead and start with that report and share it with any other professionals. But I'd review it thoroughly with your agent. I'd review it in person at the property, and I'd call them on the phone first and foremost and ask for 5 to 10 minutes of free time just to say, please speak with me about your findings. Should I be concerned about the furnace not having access to the filter? Should I be concerned about the, visible water damage above the window in the back bedroom? Is that a problem? Do you think I should have it further inspected? They may not be able to tell you how much it costs exactly. They may not be able to tell you the age or timing of repair and such, but they'll give you a pretty good start, and it may help to confirm for you the determination as to how interested you are in that house. If you wanted something more specialized, like a inspection of the flue or a roof that wasn't actually inspected by the general property, or a pest report that wasn't done, you would have to pay for that on your own, and I would only do that if you absolutely had to. Okay, any other questions? I'm happy to answer them. I want to thank you all for coming through. I'm going to take note of those who requested the access to the G Drive folder and go ahead and send you over a link to that at the end of this. So I appreciate it very much, your attending, and glad you thought it was an informative presentation. Thank you again, Sheka, Eric, Nicholas, Ivan, of course, Alex, all of you for chiming in, and certainly you all wish you the best this weekend and best in the market coming forward this spring. I think you've been wise to attend a presentation like this, from whatever you've gotten out of it. I think some of this information has to come repetitively. I encourage and invite people to have redundant questions. Sometimes the way we answer things might mean one thing at a certain point to us and later have more resonance. So working with a local agent and developing trust with somebody you want to be their advisor, that kind of value is far more important than just considering it from a commission perspective or even a sales perspective. I think it's really important to develop a relationship with somebody you trust and be able to define for yourself real estate advisement and help you make a sound decision, one that not only protects you in contract, but also allows you to feel really very little buyer's remorse and confidence in your ability to make that purchase. So I am taking note of all the people who wanted to get a link to this. So thank you again.